Listen, most people go shopping and completely miss the stock market. I did the same thing in 1977. Then one piece of paper changed everything. It was a receipt, a $50 receipt, and that receipt taught me how to find 10 baggers hiding in plain sight. Let me tell you a story that most people don't know about me. It's 1977. I'm running the Magellan Fund at Fidelity. I'm supposed to be this sophisticated investor, reading financial reports, meeting with CEOs, analyzing balance sheets, and I was doing all of that, but I was also doing something else, something that Wall Street thought was beneath them. I was paying attention to my Saturday mornings. One Saturday, I took my kids to get donuts. We went to this place called Dunkin Donuts, and while I was standing in line waiting to order, something hit me. This line was long, really long, 10, 12 people deep at 8:30 in the morning on a weekend. And these weren't just random customers. These were regulars, I could tell, because they knew exactly what they wanted. Medium coffee, 2 sugars, dozen glazed, Boston cream, make it 2, no hesitation. Muscle memory, habit, I bought my donuts, paid cash, got my receipt, $53 and change for my family. And as I'm walking back to my car, I looked at that receipt, really looked at it, and I thought, how many people just did what I did? How many Dunkin' Donuts are there? How much cash is flowing through this business every single Saturday morning? So I did what any curious investor would do. I started researching, not with a Bloomberg terminal, not with analyst reports. I just started visiting more Dunkin' Donuts locations, different neighborhoods, different times of day, weekday mornings, Sunday afternoons, late evenings. And you know what I found? Every single location had lines. Consistent traffic, repeat customers, people who couldn't start their day without that coffee and that donut. This wasn't a fad. This wasn't a trend. This was a habit. And habits print money. Now here's the part that nobody tells you. Wall Street didn't know about Dunkin' Donuts. It wasn't on their radar. It was too small, too boring, too pedestrian. The analysts were busy looking at IBM and General Motors and the big sexy names that made them feel important. But I wasn't looking for importance. I was looking for 10 baggers. A 10 bagger is a stock that goes up 10 times your money. If you invest $10,000 and it becomes $100,000, that's a 10 bagger. And let me tell you something about 10 baggers. They don't come from companies that everyone's already talking about. They come from companies that no one's paying attention to yet. Dunkin' Donuts was one of those companies. I bought the stock. I held it. And over the next several years, it became one of the best performing investments in the Magellan Fund. We made over $100 million on that position, $100 million from a donut shop that I found on a Saturday morning with my kids. And here's what kills me about this story. You were there too. Maybe not at that exact Dunkin' Donuts, but you were at some store, some restaurant, some business that was doing exactly what Dunkin' was doing. You were standing in that line. You were handing over your money. You were a satisfied customer, but you didn't see it. You didn't connect the dots. You didn't realize that your $50 receipt was actually market research, the most valuable market research on earth. Because while Wall Street was sitting in conference rooms looking at spreadsheets, you were living the answer. You were the data point. You were seeing with your own eyes that this business worked, that people loved it, that it was growing. But nobody told you that observation counts as research. Wall Street doesn't want you to know this, because if you knew this, you wouldn't need them. You wouldn't need their analysts. You wouldn't need their research reports. You wouldn't need their expensive advice. You just need to pay attention to your own life. Let me take this further. Let me show you how the most powerful research lab in the world is a place you visit every single week. It's not a library. It's not a university. It's not Wall Street. It's your local supermarket. Think about it. When you walk into a Walmart or a Costco or a Kroger, what are you seeing? You're seeing product testing in real time. You're seeing consumer behavior. You're seeing which brands are winning and which brands are losing, and this information is free. You don't need a Bloomberg terminal that costs $25,000 a year. You don't need access to proprietary databases. You just need to pay attention. Let me give you a specific example. Tide detergent. In the 1980s, I started noticing something at the supermarket. The Tide shelf was always half empty. Not because the store was out of stock, but because people were buying it faster than the store could restock it. And this wasn't at one store, it was everywhere. Meanwhile, the no-name brands, full shelves. sitting there, dusty, untouched. That told me something. It told me that Procter & Gamble, the company that makes Tide, had something called pricing power. They could charge more, and people would still buy it because they trusted the brand, because it worked, because switching to a cheaper detergent wasn't worth the risk of ruined clothes. Pricing power is one of the most important concepts in investing. It means a company can raise prices without losing customers. And when they can do that, they can handle inflation, they can handle rising costs, they can keep growing their profits even when times get tough. But you don't learn about pricing power from reading a 10K filing. You learn about it by watching which products fly off the shelf and which products collect dust. Here's another example. Home Depot. In the early 1980s, I started hearing about this store. People were talking about it. Have you been to Home Depot? It's incredible. They have everything, and it's cheaper than the local hardware store. So I visited a Home Depot, and I walked in, and the place was packed. I mean, absolutely packed. It's Saturday afternoon, and there are contractors in there with shopping carts full of lumber. There are homeowners in there buying power tools. There are retirees in there looking at light fixtures. And I'm watching this, and I'm thinking, this is a gold mine. Because what Home Depot figured out was simple. They figured out that if you give people a massive selection, low prices, and decent service, they'll drive past 10 other stores to get to you. They created destination shopping for hardware. And Wall Street had no idea. The analysts weren't going to Home Depot on Saturday afternoons. They were at the office or on the golf course or ignoring the entire home improvement sector because it seemed too boring. But I wasn't looking for exciting. I was looking for profitable. And Home Depot was both. We bought the stock early, and it became one of the greatest investments in the history of the Magellan Fund, a true multi-bagger. If you'd bought $10,000 worth of Home Depot stock in 1985 and held it for 15 years, you'd have over $400,000 from visiting a hardware store and paying attention. Now, here's the critical point. You didn't need to be a genius to see this. You didn't need an MBA from Harvard. You didn't need insider information. You just needed to go to the store, talk to the employees, watch the customers. Ask yourself, is this place busy? Are people happy? Are they coming back? That's it. That's the entire research process. Let me tell you about one more. Walmart. In the 1970s, Walmart was this regional chain in the South. They weren't national yet. They weren't the giant they'd become. But if you lived in Arkansas or Texas or Oklahoma, you knew about Walmart because Walmart was destroying the competition. How were they doing it? Low prices, better selection, clean stores, friendly staff, simple formula, brutally effective execution. And if you shopped at Walmart, you knew that this wasn't just another store. This was something different. This was a company that understood the customer, that respected the customer, that didn't treat you like you were stupid for wanting to save money. I didn't discover Walmart from an analyst report. I discovered it from talking to people who shopped there and from visiting the stores myself and from watching the parking lots fill up while the competitors sat empty. That's ground level research, and it beats top-down analysis every single time. Here's what professionals don't understand. They think research means reading reports. They think research means building financial models. They think research means attending investor conferences. But real research is watching which checkout line is longest. Real research is noticing which products are out of stock. Real research is asking the store manager, how's business? And actually listening to the answer. You can do this. You're already doing this. You just don't realize it counts. Let me tell you why Wall Street misses these opportunities. It's not because they're stupid. They're very smart people, but they're looking in the wrong place. They're looking at their computer screens when they should be looking at the real world. All right, let's make this practical. I'm going to give you a system, 5 questions. If you can answer these 5 questions about a company, you're halfway to a great investment decision. Question number 1, do you use this product or service? This is the most important filter. If you don't use it, you can't evaluate it. You don't know if it's good. You don't know if it's improving. You don't know if customers are happy. I never invested in a technology company I didn't understand. I never bought a biotech stock where I couldn't explain the drug. I never touched a financial instrument that seemed too complicated, not because I'm not smart enough, but because if I can't understand it, I can't track it. And if I can't track it, I can't know when to sell. So question 1, do you use this product? If the answer is no, move on. There are plenty of companies you do use. Question number 2, do your friends and family use this product? This tells you about market penetration. If you use it but nobody else does, maybe it's just you. Maybe you're the weird one. Maybe this product only appeals to a tiny niche. But if you use it and your neighbor uses it and your coworker uses it and your sister uses it, now you're onto something. Now you're seeing real adoption. Now you're seeing a trend. When I found Dunkin Donuts, I didn't just ask myself if I liked it, I asked, do other people like it? And the answer was yes, overwhelmingly yes. Question number 3, have you noticed price increases? This is your pricing power test. If a company keeps raising prices and you keep buying, that's a sign of strength. That's a sign they have something you can't get anywhere else, or something you trust enough that switching isn't worth the hassle. Starbucks is a great example. 20 years ago, coffee was $1. Now it's $5, $6, $7 for some of these fancy drinks. And people still line up every morning. That's pricing power, and pricing power is gold for investors. Question number 4, who are the competitors and why are people choosing this company instead? You need to understand the landscape. Is this company winning because they're better, or are they winning because they're cheaper, or are they winning because there's no competition yet? If they're winning because they're better, that's sustainable. If they're winning because they're cheaper, that's dangerous. Someone can always undercut on price. If they're winning because there's no competition, be careful. Competition is coming. It always comes. Home Depot won because they were better, bigger selection, lower prices, better experience. That's a durable advantage. Some dot-com companies in the 1990s won because there was no competition yet. Then competition arrived and they died. Big difference. Now, question number 5, will this company still be here in 5 years? This is your longevity test. Some businesses are fads, some are trends, some are permanent. Pet rocks were a fad. Nobody's buying pet rocks today. Fidget spinners were a trend. They had a good run, then they disappeared. Coffee is permanent. People have been drinking coffee for hundreds of years. They'll be drinking coffee for hundreds more. If you can't see the company existing in 5 years, don't invest. You need time for compounding to work. You need time for the business to grow. You need time for the stock to reflect the reality of the business. Impatient money rarely wins. Patient money almost always does. So those are your 5 questions. Do you use it? Do others use it? Can they raise prices? Why are they winning? Will they still be here in 5 years? If you can answer those 5 questions with confidence, you've done more research than most professional analysts. I'm not kidding. Most analysts never visit the stores. They never talk to the customers. They never use the products. They just read the earnings reports and build spreadsheets. You're living the answer. You're the customer. You're the data point. That's your edge. Now, I know what you're thinking. Peter, this sounds too simple. Investing can't be this easy. And you're right. It's not easy, but it is simple. There's a difference. Simple doesn't mean effortless. Simple means clear. Simple means focused. Simple means you know exactly what you're looking for. Let me destroy a myth that Wall Street loves to perpetuate. They want you to believe that investing requires expertise, that you need certifications, that you need access to special information, that you need to understand complex financial models. It's nonsense. The best investment ideas I ever had came from observation, not analysis. They came from walking around with my eyes open. They came from being curious. They came from asking questions. Let me tell you about Legs pantyhose. In the 1970s, I was walking through a supermarket and I saw something strange. There was a display of pantyhose in the supermarket, not in a department store, not in a specialty shop, in a supermarket, next to the bread and milk. And women were buying them. A lot of women just grabbing them off the rack and tossing them in their carts like they were buying eggs. This was revolutionary because before Legs, if you wanted to buy pantyhose, you had to go to a department store, you had to deal with a salesperson, you had to try them on. It was a whole production, but Legs figured out that women didn't want a production. They just wanted convenient, affordable pantyhose. So Legs put them in supermarkets in a distinctive egg-shaped package at a reasonable price. Brilliant. I didn't learn about Legs from an analyst report. I learned about it from watching women shop, and I bought the stock in the company that owned Legs, and it did extremely well. That's observation. That's ground-level research. That's being present in the real world instead of locked in an office. Here's another one, Taco Bell. In the early 1980s, I started noticing Taco Bell restaurants popping up everywhere, and they were always busy. Drive-through lines wrapped around the building. High school kids loved it. College kids loved it. Families loved it. And I thought, this is interesting. Mexican food for the masses, fast food, but different from burgers. So I visited a few locations. I ordered the food. I talked to the employees. I watched the customers, and everything checked out. The food was decent. The prices were low. The service was fast. The brand was catching on. I bought the stock in the parent company, and it was a huge winner for the fund. Again, no complex analysis, no financial engineering, just paying attention to what was working in the real world. Here's what I want you to understand. The market isn't some abstract thing that exists on a computer screen. The market is companies, and companies are just groups of people selling products to other people. If you understand people, you can understand companies. If you understand what people want, what people buy, what people love, you can find great investments. You don't need a PhD in economics. You need curiosity and common sense. Let me give you a counterexample. Let me tell you about the investments I avoided because I didn't understand them. In the 1990s, everyone was going crazy for technology stocks, .com this, .com that, companies with no profits, no products, just a website and a dream. And Wall Street was throwing billions of dollars at them. People kept asking me, Peter, why aren't you buying these? You're missing out. These are the future. And my answer was always the same. I don't understand the business model. I don't know how they're going to make money. I don't see the value. I missed some winners, sure, but I avoided a catastrophe. When the dot-com bubble burst in 2000, trillions of dollars evaporated. People lost everything. Life savings gone, retirement funds destroyed, and I slept fine because I wasn't invested in things I didn't understand. That's the power of staying in your circle of competence. You don't have to invest in everything. You don't have to chase every hot trend. You just have to find a few great companies that you understand, that you believe in, that you can monitor because they're part of your daily life. And then you hold them. You let them grow. You let compounding do its magic. That's how you build wealth. Not by being clever, by being patient and observant. Now, here's where most people go wrong. They understand this concept intellectually, but they don't actually do it. They still try to find the next hot stock tip. They still listen to some talking head on TV telling them to buy this or sell that. Don't do that. Trust yourself. Trust your observations. You know more than you think you do. All right, let's make this real. Let's turn this from a theory into action. Here's what I want you to do this week. Just this week, one simple exercise. Step one, go to the supermarket, not to buy groceries. I mean, you can buy groceries. But your real mission is observation. You're going to walk through that store like a detective. You're going to look for clues. Step two, pay attention to traffic. Which aisles are crowded? Which checkout lines are longest? Which brands do people reach for without hesitation? Where are there empty shelves? Empty shelves are a signal. It means demand is exceeding supply. It means people want this product so badly that the store can't keep it in stock. That's a good sign. Step three, look at your receipt. When you're done shopping, don't just throw that receipt away. Actually read it. What did you buy? What brands? How much did you spend? Now ask yourself, are these companies publicly traded? Can I invest in them? Most of them are. Procter & Gamble, Coca-Cola, PepsiCo, Nestle, Unilever, General Mills, Kellogg's, Kraft Heinz. These are all public companies. You can own a piece of them. Step four, research one company. Pick one brand from your receipt, just one, and spend 30 minutes learning about that company. Not from complicated financial websites, just basic research. Go to Google, type in the company name plus investor relations. Most big companies have an investor relations page where they share basic information, revenue, profit, growth rate. Read the latest earnings report. Don't worry if you don't understand everything. Just look for the headline numbers. Is revenue growing? Is profit growing? Is the company expanding? If the answers are yes, yes, and yes, you're looking at a potential investment. Step five, watch that company. Don't buy anything yet, just watch. For the next month, pay attention every time you see that brand in your own shopping, in your friends' shopping, in advertisements, in news articles. Are they growing? Are they innovating? Are they staying relevant? If after a month you're more convinced than you were at the beginning, then maybe it's time to invest. But here's the key. You're not gambling. You're not speculating. You're investing in a company you understand, that you use, that you've watched, that you believe in. That's how 10-baggers are found, not in boardrooms, not in analyst reports, in your daily life. Let me leave you with this. The greatest investors in history weren't the smartest people in the room. They were the most observant. They were the ones who paid attention while everyone else was distracted. Warren Buffett found some of his best investments by reading annual reports and visiting companies. Charlie Munger found investments by asking simple questions. Ben Graham found them by looking for value where others saw nothing. And I found mine by shopping, by taking my kids to Dunkin Donuts, by walking through Home Depot, by noticing which stores were busy and which stores were empty. You can do the same thing, starting today, starting with your next shopping trip. The stock market isn't some mystical, unreachable thing. It's a collection of businesses. And businesses succeed or fail based on one simple thing. Do customers want what they're selling? You're the customer. You have the answer. Stop looking for the secret formula. Stop waiting for the perfect stock tip. Stop thinking you need to be smarter or luckier or more connected. You already have everything you need. You just need to pay attention. That $50 receipt in your wallet, it might be worth $1 million if you know how to read it. Now go find your 10-bagger. The best investment advice I can give you is simple. Invest in what you know, watch what you buy, trust your observations, and remember, the stock market isn't somewhere else. It's everywhere, including your grocery store. You just have to look.